Vamos a ver si se conecta al de YouTube. Ya se conectó. Ah, ya se conectó al de LinkedIn. A ver, déjame ver el de YouTube. Aquí mantenemos la comunicación ya está en el live en el YouTube. Eh, entonces vamos a mantener aquí la comunicación por Meet, ¿no? O cómo ves. O por el Meet, o abrimos chat. Ok, espérame, es que no entra en el. Ah, ya entró en el LinkedIn. Bien. Ok, entonces ya, nada más quiero que estés en el LinkedIn. Ya tienes la pantalla abierta del live del bueno y del YouTube. Sí, ya está ahorita ahorita todavía no voy live porque le tengo que apretar otro botón, pero creo que en YouTube ya estoy en live. Sí, ahí se repite el conteo pero vamos a entrar en 5 minutos. Y entonces ya tienes el conteo en YouTube y ya tienes el conteo en LinkedIn. Nomás quiero confirmar. En LinkedIn. A ver. No, a mí sí me sale. Bueno, a lo mejor te sale cuando vaya a live, me imagino. Pero a mí ya me sale aquí en el preview. Ok, ok. Ok, yo creo que te va a salir cuando vaya a live. Si quieres le colgamos y abre ventana de chat del este del, del Google Chat, ¿sale? Y ahí me comunicas cualquier cosa. Órale, sale, bye. Hello, hello, hello. Thank you for being here in my first live stream chasing the deal. This is new for me. It's the first time I go live with this kind of the dynamic. I want to teach people how I choose properties to invest in, and I will try to make this very fun and very educative. Yeah, but please, if I have some mistakes, just don't be very hard with me. It's my first time, and this live stream will gonna take about 1 hour, and we started last week promoting this event, and we make a poll to choose the city. We had 3 cities to choose from. It was Austin, Texas. Austin is a big market for growing market for data centers, for intelligence, for artificial intelligence, and also we have Houston. Houston is, I think, one of the big ports in the U.S. It has access to all of the northeast of the U.S., and it's a very big port. And finally, we have Dallas. Dallas, it's I think the fourth metroplex in the U.S. And it is a logistics hub. A logistic hub. It has many highways here crossing all over Dallas, and it has one of the biggest airports, the Dallas Fort Worth Airport. So we asked for comments on LinkedIn, and if you don't follow me on LinkedIn, follow me to vote on these polls, and the we are going to be constantly asking you which market you want to go to make this the next episode. So this time I think Dallas was the winner. So Dallas, it's as I told you, it's a huge market, and it's a very growing market. Recently, it had been a buyer's market, but this 2025 it's turning to be a seller's market. You know, I think it's a big time to invest in Dallas before it turns to a seller's market. So the first thing we are gonna do, it's we use let me show you guys. Um, Let me show you this thing. I have an property analysis software I always use. Its name is CoStar. Some of you may already know it. Some of you may not. But this is very powerful property intelligence software. So I'm gonna choose you this one. I hope you guys are watching the screen. Um, Let me see. Where's the screen? Okay. 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 Let me see. Okay. Okay. This is the software, guys. And as you can see, this is the market for Austin. Yeah. As you can see, the blue properties are the properties that are on the market. That means are for sale. You know, so are either for sale or either for lease, because I have not filtered yet. So and all other the gray properties are commercial properties, but um, let me. I think I have a problem with the audio. Okay. Desktop. Okay. let me see. Can you hear me better, guys? Okay, I think it has some echo, so okay, let me see. I have some echo. Okay. Capture. Okay. Okay, I have some problem with the audio, guys. Okay. 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 Let me. Okay. Okay. You still hear some echo, guys? Okay. Okay, we have those properties. Okay, I think the audio is okay now. Okay. Okay, you see my webcam. Okay. Okay, guys, I'm sorry for that. Okay, so we have these gray properties. The properties in gray are all the commercial properties that are in Austin, and the blue ones are on the market. That means are either for sale or are either for lease. So let's go for it, and let's go to search for the Dallas market. Okay. Okay, so let's go. So we are going to analyze, we are going to search for industrial properties. This time, in other next episodes, we may analyze multifamily, maybe office, but in Dallas, as I told you, industrial property is booming right now. So here we can filter up all the properties, and as you see, we can see properties either for all the properties, but we are gonna filter up for sale properties only. You see, and all these blue properties are properties on the market. And this software makes a really good job filtering up all the properties that are on the market, because this software, guys, CoStar has people that actually calls the brokers and the owners of the buildings. So they have really fresh information about the properties that are on the market, or sometimes the price of the properties that just got sold. For that, I have another section here that says shows sales, but this time I'm not gonna show you guys this section, because we're gonna go to the point. But I just want to tell you that there's another option. You can go and see all the sales, and also all the properties for leasing. You have this section. You can ask for. And also you can find even tenants here, and you can find other brokers here, or other developers, or other investors here. It's a really good, it makes a really good job doing filtering up all the data in the commercial uh, properties. So let's do it, guys. So first of all, I want to show you some data about the market. Those are the properties, but I'm gonna show you some data about the market. Okay, I'm gonna show you about the markets on industrial properties, so you can get an idea how. Um, Let me see here. Okay, so you can have an idea of how well is the market going, you know. Okay, so for example, we have data for every market, every major market in the US, all over the US, as you can see, guys. And this is just for industrial, but I can choose for any type of property. And let's see for industrial in Dallas. Okay, so as you can see, I have the market data for all the Dallas Fort Worth area, but I can even subdivide. I can even go in more detail, and let me see, sub markets. I can even go to the sub markets detail. You know, for example, this Southeast Dallas, it's a good market right now for data centers. There are many data centers being built in this area, and for example, here close to the airport, there are many also warehouses being built, because there's an ongoing expansion on the Dallas Fort Worth airport, and there are many new construction here for industrial. But this time we're gonna see only the market data, so you can see the overall data, the vacancies, the construction, the sales, the leases, uh, about this entire Dallas Fort Worth market. So let's go. Let's see some data about the market before we dip inside on the properties. Um, okay. So as you can see, we can see a summary here at the top of the report. Uh, so we can see, despite the high vacancy rates on the ongoing move out, Dallas Fort Worth industrial market continues to demonstrate resilience with strong tenant demand, positive net absorption, and developers pursue new projects. Okay, so as I told you, it was just after the 22, the Dallas market went to a seller's market, and a buyer's market. I mean, that's why we see high vacancy numbers, and also we had a lot of inventory, a lot of new inventory, a lot of new construction, at over construction actually. So but as the report say, the net absorption has been unexpectedly robust during the uncertain times brought about by shifting change in the natural trade policies. Okay, local users are confident enough to take on more space, and developers are willing to break new ground despite vacancy rates holding at 9.1%, still ranking among the highest in the top 20 industrial markets. Okay, rent growth. We still see, even if it was a buyer's market in high vacancies, we see rent growth. rent growth is often cited as key driver for this enthusiastic development. Though annual gains have softened over the last 2.5 years. Okay. Okay, so let's see some numbers, guys. Okay, the availability and the market rent on industrial, the average in the Dallas-Fort Worth submarket, it's about $10 per square feet. It's up from a year ago that was 9.71. It was a 4.17%. So it is in the line of the inflation, a little bit more of inflation. So and the national average is 12. Because we have very high rent buildings in, for example, California. Okay, and the vacancy is reducing. So a year ago it was 114,000, and now it's 110,000. So we are having a positive absorption. Okay. Okay. What else we can see? Inventory. That's what I saw. I told you guys. We see a raise on inventory, but a little bit of raise. Okay. Just 200 buildings more. Inventory in square foot, 1.2 billion. Average square feet. Average square feet. This is important, guys. The average is 48,000 square feet. So that means we don't have like a lot of big warehouses. So that means we have maybe service business occupying these small to medium sized warehouses, and we see we see that are almost 36 million square foot under construction. Okay, and delivered almost 20 million. So let's see the demand. The absorption is positive, guys. 22, almost 23 million. From a year ago, it was 2 million more from a year ago. Transactions, 12-month transactions, 1,500. Market sale per square foot, 133. It's a good price per square feet. So that means maybe those buildings are not that old. Maybe are new buildings, many of them. So that's why we can see a good price. And we can see the range of the absorption. It's about 5.54% and 8%, and we have now a 9% absorption rate. Delivered, market asking rent growth. Okay. The market sale price per square feet, $10. Okay, here in this graph we can see like the vacancy, as I told you guys. After 22 it went up to the beginning of 25, and it's going down from the first quarter of 25. It's going down, so it may be a good time to purchase a property, because the long term or the short and mid term forecast is the vacancy to go down. You know, it's ahead of the tendencies of the US. And the net absorption is going up, as you see. So if you start, for example, building one warehouse today, and you finish building it 2 years from now, uh, we will see growing in 2 years from the on the net absorption. So that means your building maybe may cost more, and your rents, you can ask more for the rents. Okay, leasing activity. Okay. Availability, logistics, especially this is for types of properties, flex. You see, this is interesting, guys. It goes in the same line as I told you before. The small spaces are working better here in Dallas, or at least are more profitable. You know, because for example, flex spaces tend to be small spaces for service business, or for small business, and we have an availability of 4% of, excuse me, 6.8%, and compared to logistics is 12% in the first quarter of 2025. Okay, so that means the flex spaces for the small business have more demand than the actually it's very rational, this data, because it's easier to rent for small businesses than to large businesses. But there's an opportunity here to build a new flex spaces here in between, let's say, 50 to 100k square feet. There's a niche there here in Dallas, at least. Okay, monsoon market. You see, the monsoon market in the US is more than in Dallas. 6 months to lease. 6 months. Rent. We see a little bit of drop in the rent from the mid of the year here, because of the policies of the commerce, the commerce policies, the tariffs. We see maybe a little bit less activity here from the mid of the year, but the tendency was from the beginning of the year was upside, but then from the middle it was downside. You see the market rent growing, construction. Under construction, we had a bit, as I told you guys, We had a boom in construction in 2022, but then we have an over inventory, and the developers have, since that they have been quit from building too much. And now from the last quarter of 24 we are seeing a little bit of increase on the new developments on industrial. Okay, so let's go to search for some properties, guys. Okay, let's go for look for some properties. Okay, Dallas forward, listing type, for sale, property, let's say industrial, and let's check flex. Okay, and as I told you, I see a niche here from 50,000. We don't want to go under 50,000 because maybe those are many mom and pop businesses, and we want at least a medium to big business, so we can, so if we can have a solid rent, a solid credit tenant, because otherwise if you rent for first time entrepreneurs or things like that, they usually go for the to look for under 50K, and but from 50 to 100,000 you are not on the big whales side, you know what I mean? So you are not competing for rents for with all those big guys like Prologis and CBRE, and those big guys, because they are not interested in small and really small warehouses. But you are not also going to find tenants like lower credit tenants, you know. So 50 to 100, I think it's a niche of opportunity. As we see on the market data, we have around 5 or 6% availability. That means we have a low vacancy there, so we are going to find tenants easier than big spaces, and maybe we are going to be more profitable. So if we are going to look some property in that range, uh, I suggest to go for some. Well, we have to first define our strategy. So I'm gonna be honest, guys. If you are going, there are many kind of strategies here you can follow to invest in real estate, especially in industrial. The most risky space is development from the ground up, you know, or redevelopment. That means you've redevelopment means maybe you have a space for retail use and you want to rezone for an industrial use. Okay, and you want to rezone for industrial use, and that's risky. That's for more experts, investors, experienced investors, you know. Then you have the value added strategy. The value added strategy, you can, for example, invest in a warehouse, but that warehouse is maybe you maybe fix it up, or you may build uh, in you know, it has a big piece of land, and maybe you want to build another building. Okay, so that is less risky than building from the ground up, and you can earn good returns on that. And then the less riskier strategy for the most beginners, and this is what I recommend, for example, for foreigners, it's the core investment or the core plus investment. That means the core investment, you have a good building, it's rented out, you have a good numbers, or at least you have cash flow, positive cash flow, and the core plus, it's the same thing, but you can, for example, the rents on that property are below the market rents. So for example, the last owner, it's charging let's say $8, and you see the average rent in dollars, it's $10. So that means you can raise the rent $2. Okay, so that means around 25% plus. So the things, how it works here in the commercial real estate, it's once you raise the rents in the in the property, guess what, your property value rises. Okay, because here in the commercial, it's all about the cash flow, you know. So the easiest way to find the value of the property is your cash flow or your net operating income divided by the cap rate. And the cap rate, it's a number I will tell you later. It's a number you find on the market. That's not a number you can just choose. It's something you can find on similar properties on that market. So if you increase, you have two ways to increase the value of the property. Either you increase your net operating income, and that means you increase the rent or you reduce your operating expenses, or either you find a more credit tenant and you reduce the cap rate. That's not as easy as it sounds, but you can also reduce the cap rate if you, for example, if you rezone a building. Okay, so for example, if you rezone, let's say, a retail or an industrial to a retail, you can compress the cap rate. Okay, and then your property value goes up. Okay, so I recommend for first time investors and also for foreigners to start with the core, maybe with the core plus, because you don't have the experience or the team or the economics of scale to to invest and take advantage of that investment, like a construction, or many things can go wrong if you go for the more risky strategy. So you, for the first time investor, I recommend core or core plus. So in this property, we are gonna look for properties from 50 to 100k. Okay, so let's see, let's set the filter that way, and we can see we have only 80 properties on the market here in Dallas. Okay, so as I told you, these kind of properties are small, like service business, like maybe a car shop or something like that, glass business, or I don't know, like local businesses. Okay, so these businesses are. It's not very important to be like close to the airport. Okay, these businesses, it's more important to be on the market, on a huge market, because if you have, for example, a roofing company or a construction company, you don't want to be close to the airport because you're not importing or exporting things. Okay, you want to be in a market that it's, for example, a roofing company. Where you want to be located in when you if you have a roofing company, you want to be located in an area that has old houses, that wants to replace the roof, for example. So you don't go to McKinney, for example, because those houses are new. You have to think as an investor. You don't have to think only on the numbers and the rents. You have to think as the tenant. You know, if you want to make a big business, a good business, you have to think as the tenant. Okay, so if your tenant is a roofing company, you want to 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 locate your business in an area that has all houses. Okay, so for example, Garland is in a good area because it has all houses. Okay, and has an income for about 50 to 100K. So that means these people can afford to pay for your services. So this time, let's gonna see just these four properties. Okay, so to reduce the search for just these four properties, let's make a radius. Okay, and now we have only four properties. Okay, this one, you can see only these four properties. This one, it's 63,000. This other, you can see highlighted in yellow, it's almost 60,000. Okay, this almost 100. Okay, and 60. Okay, so wow, 20 millions for sale. Okay, I think this is very very expensive, but okay, most of the properties you will find, they have no the price disclosed. Okay, because for example, you can see here, this one is almost 8 million. Okay, and this one is 20 million, so automatically this one is out. At least maybe the data is wrong or something, I'm missing something, but I think it's too out of the market, this property. Okay, even if it's new property, but most of them are, they don't disclose the price. So that's why you need a real estate agent, because a real estate agent, we call them and we find all the information, and we can make all the analysis to tell you if it's overpriced or maybe underpriced. And also to price it, you have to get the cash flows of the property. You no property, it's very rare that you find a property with all the cash flows published. So you have to contact the owner and get the cash flow, and to value the property. So let's say this one is too expensive. So let's say between we have three options here. Okay. So I don't know how many of you are on the chat, but let's start with the poll. So you can tell me which property you want me to analyze. This one is 601 Shepherd, 2010 Merit, number two, and 3615 Security. Which one do you want you want me to analyze? This is 1971, 1986, and 1973. It's pretty similar properties. So let's get 2 or 3 minutes so you can vote and you can decide which one you want me to analyze. Number one, Shepherd. Number two, Merit. And number three, Security. Okay. Okay, show me your comments so we can decide which one you want me to get more data and analyze. Okay, guys, let's choose one property. It looks like the first one, Shepherd. Let's analyze this one. Okay. Okay. Okay, we have this one. It's I think it's a flex space. Yeah, it's a flex space. It was leased on, yeah. The last rent we have it's $5.25 with 25 cents. Okay, that may be a gross. We don't know if that is a gross rent or that is a triple net rent. I will say that is a gross rent. Okay, for sale for almost 8 million. Okay. Okay. we see it has a 63 square feet, 63,000 square feet, but it has a 4-acre lot, so it has roughly like 35% building area. So it has, maybe we have to, we if we want to find if we can build something else, the first thing we have to do is go to the zoning of the city and find how many parking spaces we can build, we have to build for that kind of property. First, the zoning. I guess the zoning is for flex buildings, but we have to double check on the city, and then we have to see the floor area ratio, FAR. Okay, so we have 63,000 square feet for building, and we have a 4-lot building. That means we have roughly like 35% of floor area ratio. Okay, so if we want to build more, if we want to make sure, if we can expand the building, we need to go to the city of Garland website, or to the city building department or zoning department, and they will tell us what is the FAR for the building and how many parking spaces we have to build. Okay, so CoStar estimated rent is 8 to 9 per square feet. Okay, and then we see the last rent of this property is 525, but it was like 6 years ago, so they probably raised the rents up to the market, or maybe are under the market. Okay, so if those are under the market, we have an opportunity there to raise the rents. Okay, this is information from the public records. The assessment value, that's not like an appraiser value, but that's for the city. It's for the purposes of the taxes. The assessment value, it's 4 million. So if we are looking, they are asking for double of the assessment value. That doesn't mean the property is overpriced. Okay, that's only for taxing purposes. Okay, we see demographics data here. A population of 16,000. Median income 40,000. Okay, and 3 miles 50,000. Okay, let me see. Okay, tenants, we don't have information on the tenants here, and we have one tenant, Dallas Press, that we don't have the lease information, but we know they are occupying half of the building, 38,000 at least. Okay, we can see also the owner here. We can call directly the owner, or we can call the broker. It's 25 minutes from the Dallas Love Airport. It's not that far away. Year built 1971. Okay, we can see here the parking ratio. We need 63% per mil square feet. Okay, so we need a lot of parking. So that means we probably cannot expand the building, because if the parking ratio is 73% and we and the building, the FAR, it's the building area, it's roughly 35%, that means we cannot expand the building. Okay, so we cross that possibility. What we can do here is raise the rent. I think it's the only thing we can do. Maybe we can rezone to retail, but I don't recommend, because the income of the area. So probably an industrial or flex building is better. Let's see the map. We have closed the 635. We have an avenue here, the Forest Lane. Yeah, but for retail, it's not like a big opportunity, because it's not in front of an avenue or in a highway. Okay, so I think we may not rezone this property. We'll leave it as that, as a flex building. Oh man, I just went back. Okay. Okay, let me go back. Okay, let's see the financials. We have the financials here. Okay, but this is not for the property. As we can see, it's for the market. So this gives you an idea of the market, the rental market of this area. 26 base rent. Okay, it's good. Operating expenses. Okay, almost 50% operating expenses. Okay, net cash flow. Okay, let's go to the top. Income, you charge 26. Expense reimbursement 1.6757. Okay, so that's why the effective gross income, it's more, because you are recovering expenses. You are charging the rent and you are recovering expenses. You may recover, I don't know, maybe maintenance or something. So you end up with almost $28 in your pocket, but then you have to pay all these operating expenses. Okay, as I told you, operating expense ratio, almost, that's the expense ratio 35%. That means it's not that old building, and it's properly administered. If you have more than 35, it's probably an old building, and you have to spend on many things, because the building is falling apart. Okay, so you have 17.82. That is very, something may be wrong here, because last year, 2023, the net operating expense was 5.45, and then the next year it was almost, it tripled. What's going on here, man? Okay, something is very strange here, because the 2023, the rent, maybe it was a rezoning or something, I don't know. Well, but this is for the market, so Okay, so we don't trust this data because, you know, 2022 it was 7, 23, 7, and then 24, 26 for the whole market, Dallas forward. It's very strange, you know. It's very strange. Okay, but that gives us an idea. As we see, the market range suggested by CoStar was 8 to 9 to 10 or 9, I think. So we are gonna see we have an $8 rent and 35 operating expenses ratio. Okay, analytics. Okay, we see also the market rent 860, submarket 960. Okay, okay, so we have 63. Let's go to the numbers, guys. Let's go to the numbers. How profitable, how much we can pay for this property. Okay, just one thing more, the cap rate, market, vacancy, occupancy. Okay, the vacancy, how much is the vacancy? 6%. Okay, market asking rent. Okay, daily cap rate. Let's see the cap rate. This is important, guys. 663. Okay, in 2026, 660. Okay, 6.5. Let's say 6.5, and in 5 years 6.6. Okay, in 5 years 6 point. Okay, 6.3. Okay, okay, let's do this, guys. Okay, so we have, let's say we charge for this property $10. Let's be optimistic. Okay, $10 per square feet. Okay, and we have 63,000. Okay, so 63,000 by $10. Okay, the vacancy, let's say it's 0.65. Okay, and we see the OPEX multiple, let's say it's 36, and a rental increase of 3%. Let's say it's 3%. Okay, okay, let me explain these numbers. So that means okay, so that means, okay, the cap rate we saw it's 0.065, and the exit cap rate is 65. Okay, Okay, there are two ways we can grossly calculate the value of a commercial property. One is for the reversal of cash flow, to calculating the net present value of the cash flows of the property, and one faster, it's by the cap rate. So we see the cap rate here in the area, it's 0.065. So if we calculate the income based on the area, rentable area of the property, and the rent per square feet, that is $10, it's the maximum. Okay, because according to CoStar, the expected rent per square feet it's 8 to 10. Okay, we write 10. Okay, we write the vacancy on the market 7%, and OPEX multiple, optimistic multiple, because if it's an old property we may have more expenses, maybe it's 40 or 50, but let's say it's 36%. Okay, and we have a rent increase of 3% annually. So then we have the cash flows here for the year 1, year 2, 3, 4, 5. Okay, so the first year we make subtracting the vacancy here, we have this number, and then the OPEX, the operating expenses. Okay, and then we have the net operating income. Then we have to bring those value, those cash flows, because this we don't receive it right now, we receive it at the end of the year. So we have to we receive this one at the end of the year, so we have to bring it up to present value, this number, and that is the number, it's here. So then we do the same thing with the year 2, year 3, year 5, year 4, and year 5. Why year 5? Because I'm assuming we are holding the property 5 years. Why 5 years? Because most of the commercial loans start from 5 years. If you want to keep the property in a core strategy, most probably the bank will loan you from 5 to 10 years. So we have to hold it 5 years. Otherwise, we have to, if we sell in year 3, we have to pay a penalization fee to the bank. So I'm expecting we are holding the company, the property 5 years. Okay, but this is not the only cash flow we have. Not only the rents. Okay, we also have the reverse, what we call the reversion value of the property, how much it will be valued after we sell the property. Okay, so according to do that, we have to find an exit cap rate. We have the entrance cap rate, that's how the market cap rate is right now, and we have the exit cap rate. According to CoStar, the exit cap rate will be around the same, maybe dropping from here to 5 years. Okay, so let's say it's the same cap rate. Actually it's dropping, but let's say it's the same cap rate. Okay, let's say it dropped to 6.3%, just to be more optimistic. Okay, so that means when we sell the property, we sell it for a little bit more because we compress the cap rate. Well, we didn't compress the cap rate, but the market compressed it. Why? Because maybe of the rates of the Federal Reserve, if they go down, all cap rates go down because you are competing to the Federal Reserve. So if the Federal Reserve goes up, the cap rate goes up, and you lose value on your property. Okay, but when the rates goes down, the cap rates goes down. So probably in 5 years, the Federal Reserve rates go down, and then makes and pulls the cap rates of the property down. So we can sell the property in more expensive than today. So we sell for 5.3 million, and then we have to present value this, and then we have to sum this present value of the cash flows of the rents, and we have a present value we can pay for the property of 5.8 millions, 5.85 millions. If we do it by the present value, by bringing all the cash flows from the 5 years and the sale of the property up to today, this is what this is what we may pay for the property. But the seller is asking, let me see. He is asking 8 millions. So that property is overpriced. Okay? With this strategy, why we may pay more for this property? It's probable that the present value of the property is 5.85 millions, but the actual value of the property is more. Because let's think about it. For example, a piece of land has no cash flow. Does that mean has no value? Not at all. It has value. So if the property has a big piece of land, or the market it's going up and the cap rates are going down, and you are expecting the property be more expensive in 5-10 years, you may pay more for that property. But as we already analyzed, the property has no field, no space for a value add, or maybe a ground up development, or maybe the market will go up. No, Garland, it's a stabilized market. So we don't have any expectation of the property going up in price by themselves. Okay, so we have to only analyze the present value of the cash flows. So that means this property is overpriced, guys. It's if we value by the excuse me. Oh, I made one mistake. I'm sorry. These are it's a variable for the present value. It's the rate you are asking for that investment. You know, so for commercial properties like this, you should ask something more than the Federal Reserve, or even the corporate bonds, but you should ask less than the stocks. So if we ask a return for 5%, that's the price it comes. But for example, let's say if the federal, let me see, Fed rate, okay, 4.25%. So we are above the Fed rate. So let's say a corporate rate is 6%. So let's put 7% for this investment. Okay, so that's actually worse. Okay, so the present value will be 5 million, and if we do it by the cap rate of today, that is only to value the property by the cap rate, we see the cap rate is 6.5%, and we only take into account the first year net operating income. Okay, we don't present value this income. We just take this number and divide it by the cap rate, and that's the price. That's the fastest way to calculate the price to pay for a property. So even that number is 5.8 million. But if we do it by the present value, it's between 5 and maybe 6 billion. Let's say if we put 6% for the return, 5.5 million. Okay, so the property is overpriced. So that's how you can find if the property you are investing in, it's over or underpriced and it's a deal or not. You first go see the market data, then analyze all the data, introduce in your numbers, and bring it to present value. Okay, and this is the easy way to do it for properties that you are not developing or you are not valuing at, because otherwise you have to consider all those expenses and all those increases in rents in your cash flows. But here we are only considering the increase in rent by the market 3%. So that's the only thing we are considering, and this is an overpriced property, guys. So okay, that's the end of this episode. So I hope you really enjoy this episode, and I think I don't have questions now, but I hope if you see this this video later, you can give me your comments, or you can add me to LinkedIn. You can find me as Andres Vite, or my webpage on LinkedIn. It's the Nearshoring team, and on YouTube, my YouTube and Instagram, my hashtag is my username. It's Nearshoring team. So you can ask me whenever you want, and I will reply to your comments. And also you can add me to LinkedIn and send me a message by LinkedIn, and I will contact you, and we can schedule a call. So thank you, guys. I hope you enjoyed this first episode. I know I'm not the best speaker. It's the first time for me doing this thing, so please don't be hard with me. But I hope you guys see you next time on YouTube or on LinkedIn. Follow me and subscribe. Thank you. Bye.